Value-added tax is a lovely short section that simply builds on what you learned last year in grade 11. Any business that has a total revenue or turnover, in other words, total sales of more than R1 million a year, has to register for VAT. Smaller businesses can also register voluntarily. If a business is VAT registered, it needs to submit a VAT return every 2 months. It might be on a cycle of January, February, then March and April, or it could be February and March, then April and May, etc., just depending on how or when the business registered. VAT is levied at a standard rate of 15% on all products and services. And notice it is also services, not only products. So when you incur any expense that is a service supplied by somebody else, if you paid VAT on it, you can claim it back. Similarly, if you supply services to your customers, again, those would need to have VAT on them. So the standard rate is applied unless the goods are either zero rated or exempt. Zero rated refers to items where VAT needs to be at a very low rate, basic foodstuffs, because the government is trying to spread the wealth in a sense and try not to tax the people who are poor. And basic foodstuffs is something that everybody would need. And so they keep that at as low a cost as possible. Fuel, probably because it's already got its own fuel levies and impacts on all the other costs. And that's probably why they keep that at zero rate. And exports, because the goods are going outside the country. And so the people benefiting from those goods shouldn't really have to contribute to our tax revenue. A business can claim VAT if they are registered, even if they are supplying the zero-rated items, but obviously they won't charge VAT on the zero-rated items, or rather they do charge, but at 0%, so there's no VAT. VAT-exempt items, however, are items where VAT just doesn't make sense. So they are completely excluded, and examples of these would be interest on loans and fixed deposits, etc., school fees, extra lessons, tuition, as well as salaries and wages. It makes sense not to have VAT on these, probably because a lot of the time the business is just not VAT registered, or certainly this for salaries and wages, your employees are not VAT registered. And for other items, just because it doesn't make sense. Keep in mind that even if you pay VAT on items, that doesn't automatically mean that you can claim it back. If the item does not directly contribute to your business making a profit, you can't claim the VAT back. And this is where you've probably seen that you can't claim on staff refreshments and you can't claim on passenger vehicles. Keep in mind the underlying reason. It's because those are things that don't contribute to a business actually generating its revenue that it's needed. However, if, for example, you are a supermarket and you are buying items that people might end up using as staff refreshments, if they are used to resell, obviously you can claim back on that. Passenger vehicles, if your business is a car hire business, for example, you would have to have passenger vehicles to be able to rent out to your customers. And in those cases, you would then be able to claim the VAT back on those. But you need to be able to justify it to SARS, and you don't want to get caught out. So how does VAT work? Well, all the items that would always have been in your books anyway, even if you're not VAT registered, will be at the exclusive amount. In other words, 100%. So this might be your sales, asset disposal, drawings of stock of all the things going out of the business, or trading stock, stationery, advertising, vehicles, etc., coming into the business. The VAT is then separate to that. The VAT is added on at 15%. The output VAT is then charged to customers on these items going out of the business and is then owed to SARS because it's being collected from the customers on behalf of SARS. When we buy the trading stock, stationery, etc., we would be charged input VAT by the suppliers, and then because we would have paid the suppliers, we can claim that back from SARS. So you can see over here, the output VAT is what we have to pay to SARS, but they will reimburse us for any input VAT already paid. Now notice that these two amounts together will make up your inclusive 115% amount. And that would be the amount that is the total on the invoice. So this would affect your accounts like debtors, creditors, bank, etc. That would all be the inclusive. So how does VAT work? Quite simply, all the accounts that you would have in your accounting records normally, your sales, asset disposal for the goods going out, trading stock, stationery, advertising vehicles for the goods and services coming in, all of these would need to be shown at the exclusive amount. The VAT amount is then added on to that. So output VAT is charged to your customers and is then owed to SARS because you are simply collecting the VAT on behalf of SARS. Input VAT can then be claimed as a refund from SARS because you've already paid it to your suppliers. The total amount of the exclusive plus the VAT is what we refer to as the inclusive amount. And this is the amount that would be recorded on the invoice as the total owed. And so that is the amount that will be shown in debtors, creditors, bank, or maybe even drawings if, for example, the owner took goods for his own use. When you're calculating the VAT numbers, my calculation triangle is very useful. It can also be used for calculating cost of sales, markup, all sorts of different calculations. So keep it in mind. You don't actually have to draw a triangle, but it's quite nice because it helps you remember that when we're looking for relationships between numbers, there's usually 3 numbers involved. And so it's actually quite useful to just quickly draw the little triangle so that you don't forget that. You start by putting your percentage on top. In this case, we're going to put our VAT of 15%. If you were trying to do markup calculations, you could put your markup percentage over there. The next step is to ask yourself, what is that a percentage of? Because whatever it's a percentage of needs to be the 100% at the base. In this case, that is a 15% of the exclusive amount. In other words, the amount without the VAT. Once you've entered that, you can then use these two figures together to calculate the inclusive amount as 115%. So now that you've set up the relationship between these numbers, in other words, the percentages in relation to each other, you can then apply the formula. And the formula is very simple. All that you need to do is use whatever amount was given and times it by the percentage of whatever you're looking for, divided by the percentage of whatever was given. So if, for example, they give you a figure of 4,600 Rand as the inclusive amount, that means you would use 4,600 as your amount, and your given percentage at the bottom would be the 115% because the 4,600 is inclusive. You can then work out the VAT quite simply by putting 15% at the top, or you could work out the exclusive amount by putting 100% at the top. A nice easy way of remembering this formula is also just to think of it as what I want over what I've got. Once you've done all your calculations, you can then draw up your VAT control account or SARS VAT account. It's exactly the same thing. It can have any name. Some businesses will have entries directly into the VAT control account. Others will have sub-accounts for input VAT and output VAT that then get closed off to VAT control. The important thing for you is simply to understand, do I owe SARS more or less? And just make sure that you put your entries on the correct side for whether you owe SARS more or less. Interestingly, the other account involved, if you weren't going to use your input and output VAT accounts as sub-accounts, would be your bank debtors, creditors, drawings. In other words, the inclusive amount, because remember, the VAT is on one side of the calculation and the inclusive is on the other side of the calculation. Keep in mind that your VAT can be asked as an adjustment to your financial statements, or it might be combined with any other topic like asset disposal or inventory or absolutely anything. Just look out. If it tells you the business is VAT registered with SARS, then you would need to keep in mind that you've got to calculate that 15% and keep that separate as a VAT figure. You can also have a number of VAT adjustments. And of course, by the time you're in grade 12, we expect you to do them very well and understand them nicely. Keep in mind that anything going out of the business needs to have VAT charged on it, including things like when the owner takes stock for his own use, or you're selling a vehicle or equipment. Anything going out of the business must have VAT, unless obviously it's zero rated or exempt. Where you've got adjustments for things where the original transaction value changes, in other words, your original sales or your purchases, then you also need to adjust for the VAT. So examples of these would be if you've got returns, either returns from customers to your business or returns from the business to suppliers, or discounts. Again, you might receive discounts from suppliers or offer discounts to your customers, or possibly bad debts, because that means that you are basically making the original transaction null and void because you have to write it off as an expense. Although we do still keep our sales, etc., as their accounts in our accounting records, from SARS's perspective, they understand that if you have to write off a bad debt, you shouldn't also have to absorb the VAT, because that just doesn't make sense. So SARS allows you to claim that back. Similarly, the VAT on any discounts or returns would also need to be adjusted for. All you do is you think of what would the original sales or purchases transaction have been, and then do an exact reversal.